Everyone has seen the charts showing XRP exchange balances sliding downward, and you've probably seen the spreadsheets predicting a full depletion of supply within a year. Those posts spread quickly because they're simple, dramatic, and easy to screenshot. The first impression feels powerful, especially if you hold XRP and want to understand what it means for you. This is where the picture shifts. When you look past the screenshots and into how XRP actually moves through the ecosystem, you start to see a very different picture. Exchange balances are one piece of a much bigger system, and focusing on that single number can easily lead you in the wrong direction. A wider view makes the whole landscape more accurate. Everything here is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions. If clear, no hype crypto education helps you make sense of all this. Hit like and subscribe. It tells YouTube this series is worth showing to other newcomers, and it helps me keep building it for you. Let's go deeper. In this episode, I want to take you into the liquidity mechanics behind those charts, but in a way that feels approachable. By the end, the flow of XRP between exchanges, OTCs, custodians, and ETFs won't feel mysterious or intimidating. Seeing the bigger map makes everything easier to understand. One thing to know is this. Back in part 1, we walked through how ETFs source XRP through creations, redemptions, and authorized participants. Today, we're staying with that same plumbing, but shifting the focus to what actually supports or strains XRP liquidity. That foundation will help everything we explore in later episodes make more sense. Now here's where the mechanics turn. Liquidity isn't the same thing as supply. It's really about how much size the market can absorb before price reacts. A book might show millions of XRP for sale, but if most of that sits far away from the active trading range, the market can still be thin where it matters. That distinction shapes how buyers and sellers actually meet. At this stage, the view changes. Market makers think about friction, depth, and execution quality, not just raw token counts. A well-quoted OTC desk can sometimes offer more usable liquidity than an exchange with a giant-looking book, but poor depth. The smoothness of the market often matters more than the size of it. The question beneath the question is this. When people worry that XRP will run out, they're actually asking whether tradable liquidity can stay healthy as institutional demand grows. Understanding that shift moves the conversation out of fear and into clearer territory. The data tells us something real. On-chain analytics make it easy to see exchange balances trending down through 2024 and 2025. That signal matters, but it's only one layer of the picture. When XRP leaves an exchange, it doesn't disappear. It often moves into private custody, OTC inventory, treasury accounts, or long-term storage. The XRP is still in play. It's just living in different structures with different incentives. One thing to know is this. Corporate vehicles, including public products like Evernorth's XRPN, hold XRP off-exchange in ways that don't show up in centralized exchange analytics. These holders can re-engage with the market at new price levels or through structured programs designed for deeper liquidity. Their role is quieter but still relevant. The view widens. The supply you see on exchanges is the storefront, transparent and easy to track. But behind that storefront is an entire warehouse system. Custodians, OTCs, treasury pools, and institutional inventory. That invisible layer often shapes real liquidity more than the visible one. We need to add one more dimension. ETFs change things because APs can source XRP from multiple venues. They're not required to buy from public exchanges first. OTCs and aggregated routing often handle the heavy lifting, which breaks the idea that ETF demand automatically drains exchange supply. Let's clarify the signal. Early ETF trading days often show big volume numbers, but most of that is market makers keeping the spreads tight. It feels like explosive demand, but the real impact is in net creations, not turnover. That detail makes the whole system easier to follow. One thing to know is this. The ETF behaves like a reservoir. Creations bring XRP in, redemptions release XRP out. APs shift back and forth between custody, OTCs, and exchanges to keep everything aligned with price. Thinking in terms of a reservoir makes the flow much more intuitive. One thing to note: supply shock models usually rely on the same formula. Take a visible exchange balance, subtract a fixed daily ETF demand estimate, and draw a countdown to zero. Those models look precise, but they treat the market like it's sealed off from real behavior. This is where the mechanics bend. These models assume all ETF inflows are net new. In practice, inflows are a blend of new capital, recycled capital, institutional hedging, and rebalancing. When input assumptions are rigid, the output becomes dramatic by design. A hidden assumption sits here. Many models assume dormant supply never comes back into the market. But historically, as prices rise, sidelined holders reappear. That reflexive behavior prevents depletion paths from following straight lines. There's another layer. Some assume ETFs always source XRP from public exchanges. In reality, OTCs exist specifically to avoid that footprint. A decline in exchange reserves cannot be mapped one-to-one to ETF activity. Markets adapt. Thinning books widen spreads, and wider spreads attract arbitrage desks that step in and provide liquidity. That behavior keeps the market functioning even during stress. We've seen this before. Bitcoin's exchange reserves fell after its spot ETFs launched. The trend was real, but the market didn't break. Multiple liquidity channels picked up the slack and kept price discovery intact. All of this points to something. Bitcoin ETFs pulled in massive flows, yet liquidity adapted by relocating into OTCs, custodial systems, and arbitrage networks. XRP isn't Bitcoin, but the pattern gives us a useful reference. Put the pieces together. XRP's exchange reserves sit lower. Large wallets have accumulated, and ETF pipelines are building a steady backdrop of structural demand. That points to tighter visible liquidity over time. What this really means? Tighter liquidity on exchanges doesn't signal collapse. It signals rotation. As conditions shift, XRP moves between venues and reappears at different price levels. The market adapts just like any other evolving system. One thing to know is this: as more activity migrates into institutional channels, exchanges represent a smaller share of the true liquidity picture. The system keeps functioning, just with more of the action happening behind professional walls. A slow tightening scenario is plausible. Steady ETF demand, thinner books, sharper reactions during peak interest periods. Not a forecast, just one credible path the market could take. Another path is quicker. Short-lived liquidity squeezes. A catalyst hits, demand spikes, books thin, and long-term holders re-enter as prices adjust. Markets have cycled like this for decades. And there's a third path, a fully institutional corridor, where most XRP movement runs through OTCs, custodians, and structured products. Public exchanges stay in the picture, but no longer at the center. From the outside, it can look like low liquidity, even when the deeper system is alive and moving. In the next episode, we'll shift from liquidity to allocation and look at how institutions decide when and why to add assets like XRP or Solana into real portfolios. This channel is for educational and entertainment purposes only and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.